right, we'll call the meeting to order. Roll call present. Myself, Fire Trustee Chair Eugene Dugan.
Leah Hayes, Police Trustee.
Harvey Lewis, Trustee.
Greg Williams, staff.
William Johnston, staff.
All right, we have a adoption of the agenda. I believe we are modifying the agenda to remove the terminated vested discussion until our attorney can be present next month.
That was the request.
Yes, Chairman, I requested that. I want to be there in the room. So if we could move that to the June 22nd, I think is our next meeting.
Correct.
Sounds good.
Yes, I've already made travel arrangements to be there that day, and anything else I have that day, I got somebody covered.
It's not American Airlines, right? I'm just kidding.
Yes, I am coming on American Airlines.
Okay, so we might be doing it in August then. All right, well, either way. I'm in favor of that. Is there a motion to amend the agenda as proposed?
I'll motion to amend it as proposed.
Motion second. All in favor to amend the agenda? Say
Aye.
any opposed? All right, the motion passes. We have the approval of the minutes from March 23rd, 2022. They've all been dispersed. Is there a motion to
Accept.
Second.
motion to waive the reading of the minutes is motioned and seconded? All in favor?
Aye.
Any opposed? All right, motion passes. First agenda item, we have our attorney, Bob Klausner, an update. Good morning.
Very good morning. Very briefly, the Harrison Street and Nuveen contracts are done. From our end, I think the only thing left is to get funding instructions from the managers. The folks at WTW were helpful at moving this along, which we appreciated, and the managers understood the necessity of what had to be in the contract under state law for our protection. And so I'm satisfied that from a legal standpoint that we're just protected in all respects in these investments. So I have spoken to William about it, and I don't think we have the funding instructions yet, correct?
That's correct, and we'll refer to Willis Towers Watson on this, but I don't believe immediate funding was expected. I think that typically with these managers, they call for funding to come in at some point. So, I'll work with Willis Towers Watson to see when that'll be. It'll probably be sometime, in the third or fourth quarter of 2022, I believe.
Yeah, that's exactly right, William.
We're gonna get like a 90-page subscription agreement, which you'll check like 2 boxes, because most of them don't apply to you. They'll just want assurance that you're not an ERISA plan, that you are a governmental plan, that you're a qualified investor as a result of that. And a new question that I've seen popping up, do you have sovereign immunity? The answer is yes. The only other thing is, and I have a question, when the city hires a police officer or firefighter, does the city require a pre-entry physical examination?
Yes.
There is a new statute. Yeah, was that a yes?
Yes, sir.
Well, there is a statute that takes effect past this session it takes effect on October 1, and it has to do with maintaining the records for the purposes of determining eligibility for presumptive disease coverage. And it's become particularly acute for firefighters because the cancer bill has been interpreted to apply retroactively. So if you ultimately get cancer, you would have, one of the covered cancers in the bill, there would be immediate eligibility. It really won't have an impact on the fund, but it will have an impact on the city's record keeping. When I'm there next month, I'll have a more fulsome discussion. The governor has not yet signed the bill. I have no reason to think that he will.
Okay,
And that's my report.
thank you, Bob. Does anyone have any questions for the attorney? No? All right, thank you very much, Bob. We'll move on the agenda.
All right, I'm gonna turn off the clock and good conscience says I can't charge you for this.
Thank you, sir.
Thanks, Bob.
But don't worry, I'll make up for it next
Next
month.
month, yeah.
Of course.
Wait a second,
All
Bob,
right,
attorneys
I'll-
have a conscience?
Yeah. Yeah, I bought one.
Thank you, Bob.
Okay, I'll talk to you later. Bye-bye.
Bye. Next on the agenda, we have a presentation by LSV. All right, who do we have from LSV?
James Owens is on?
James Owen.
Can you guys see me or no?
Yes.
Okay, good.
Thank you.
You all. Can you hear me too?
Yep.
Even better. And now I'm not Big Dog anymore, I'm LSV, so sorry about that.
It's all right.
I guess my kids can use my laptop from time to time. That is not my nickname.
Sure.
Well, great to see you all, I guess, on camera. Sorry that I'm not there in person. Hopefully that will change soon. Things seem to be improving in that regard. So we've gotten out and seeing a few clients here more than we have been in quite some time. So I'm looking forward to doing that myself. So good to see you all. How much time do I have, William? Or is there a set agenda time here?
We shoot for about 30 minutes
Okay.
total.
Super. Well, for those of you that don't know me, I've been working with the City of Gainesville Police Officers and Retirement Plan for since you hired us back in July of 2001. And I've been coming to the meetings throughout the years, and unfortunately, the last couple of years haven't been able to be there in person. But great to see you all, and thank you, first of all. In the almost 21 years that we've managed money for you, we started with a small cap value portfolio. That portfolio is just about 32 million at the end of April, and we have outperformed our benchmark net of fees by 130 basis points a year. In the presentation, in a few slides, I'll show you what that means in terms of compounding. And then a few years after starting small cap value, we added a large cap value mandate with you all. That portfolio is about 38 million, and that portfolio has outperformed net of fees by 90 basis points per year since inception. And I want to point out that those are not our long-term objectives. Outperformed by more, and this is a long time frame, but we are in what has been a trough for value investing that we've been coming out of since the beginning of 2021, really even late 2020. So you'll see our performance results have picked up dramatically here recently. When you hired us, we were just coming out of the tech bubble, and coming out of the tech bubble, value stocks did extremely well. So we'll talk a little bit about sort of the similarities between now and then as well. So thanks for moving on. We have about 106 billion in assets under management, about 340 clients around the globe. Really nothing has changed at LSV. We're the same firm that you hired. We're a small boutique firm based in Chicago. We have a singular focus of value equity investing, and that's really never changed. Our small cap product, which you hired first, has been closed at least since you hired us. We have remained closed in small cap for all these years. We think it's important not to manage too much money in small cap stocks in particular to give us the maneuverability. That's really important. So that product remains closed. We are open in our large cap value product, which is our largest strategy at about 30 billion in assets. And we have a total of 43 employees, 33 of which own a stake in the firm. We did make a new partner this year, but it's a pretty unique organization where a majority of our employees actually own a stake in the business. And that promotes a lot of stability. So folks like me who have more gray hair than I used to, I've been working with you all for the entire 21-year time frame. So we appreciate that support of our clients. We've had a very stable client base over the years. Even with the underperformance that value suffered the last few years, really from 2018 through the early part of the pandemic into 2021, we are thrilled that our clients stuck with us through those tough times, and most of them saw the good times too, and our long-term numbers have typically remained pretty good. So I want to talk to you a little bit about those cycles. If you go to our people, our org chart, which is on page 5, you'll see that we have had a lot of consistency in terms of personnel. The little numbers behind each person represent the years they've been with the firm, and if you're listed as a partner, that means you're an owner. Jason Karseski is a former professor at the University of Florida. He actually attended one of the meetings with me years ago. Remains a key component of our research and investment team. But we've had a lot of stability there as well. And I think that's one of the reasons why when value's out of favor, we held on to our clients quite well, because we had the same organization. We could continually demonstrate that we remain consistent in our style. And like you, most of our clients have a growth and a value manager. So it's really important that when value's doing well, we do well. That's really critical. So you'll see that in our numbers. In value periods, we tend to do quite well. And when we're out of favor, our hope is that we hang on and don't give up too much relative performance. That's kind of been the pattern that we've seen over the years. Let's jump back to page 9. This is the model approach that we use to select stocks. So we try to take sort of emotion out of the process. We don't fall in love with companies. We don't have an analyst who follows the stock who thinks I was early or won't make any mistakes. So we really want to buy stocks by the numbers. But our approach is not really, it's not a factor-based strategy. We're really trying to analyze the fundamentals of businesses. Our goal is to find healthy, cheap stocks, stocks whose valuations are trading below the market, that we think don't deserve that low valuation. So spending a lot of time on that first block of indicators, trying to identify companies that are generating a lot of free cash is extremely important, whose earnings expectations are rising, where analysts are being more optimistic about their future, who may pay a nice dividend. We're seeing some growth here. So what the danger of value investing is that you buy value traps. And value traps are companies that might be distressed or go bankrupt. So we spent most of our effort really going through and digging into the financials and trying to find new ways of identifying the healthiest cheap stocks that we can find. One of the things that we believe is that investors extrapolate the past too far into the future. So if you identify a cheap stock where maybe the sentiment is very poor, investors don't recognize that the company might be turning around. The same thing happens on the growth side. When you have stocks that are trading in PEs of 40 or sort of the darlings of the S&P today, a Google or a company like Microsoft or Apple, those companies could have an earnings tumble and investors don't run away from those stocks overnight because the expectation is that they'll get back on their growth track. When you buy a basket of companies trading at, right now your portfolios, both of them are trading at 10 or less times earnings, these companies don't have high expectations. So we're not really looking for the stocks to grow really fast. We're just looking for them to do better than expectations, and we're looking for them to get some multiple expansion. Investors start to embrace that they're actually not as troubled as maybe the market thinks. So we have a period that looks at 6 years, from 7 years ago to a year ago, where with the cheapness, we want to see a company that is disappointed investors. So that means we're seeing companies that are cheap but also have poor sentiment. And then we leave out the most recent year because here we want to see tangible signs of recovery, momentum signs. That can be share price momentum, but it's also important that it's earnings and operating momentum. We want to see companies improving. So we're constantly tinkering with these variables, trying to make them better, looking at new sources of information, trying to improve the process. And we were able to rank companies based on expected return in the small cap space and the large cap space, and our focus is companies in the top 15% of the universe. So that would be only stocks we can add to or buy in your portfolio must be in the top 15%. So that's where we sort of take our own emotion out of this, and we want to buy stocks by the numbers. If we go on to the next slide, we'll see that in small cap, we look for companies with a market cap of at least 100 million. Right now up to about 4 billion. So it kind of depends on, when we started it wasn't that big, but the market's grown over the years, and that's sort of a similar cap range to what we see in our benchmark, which is the Russell 2000 value. For large cap companies, we're ranking a broad universe here as well, and there is some overlap. $500 million and up is our objective. So we actually have some exposure in smaller names in our large cap portfolio as well, particularly if we think those stocks have a lot of expected return potential. So again, our focus is on the top 15%. We tend to be quite diversified, as you'll see, in terms of the number of names in the portfolio. And that's something that long-term gives us a pretty consistent performance pattern. And it allows us to spend most of our risk budget on being value. So you'll notice your portfolio is traded at a big discount. If you look over the 20 plus years we've managed money for Gainesville, you will see that the portfolios have traded at various discounts to our benchmark. Always cheaper, but sometimes a greater discount than others. And what does that mean for future returns? We have found that when the discounts are larger, the returns that we see going forward tend to be higher. The excess returns, I should say, tend to be higher. So that is hopefully the pattern that we've gotten into here recently. We've had a couple of head fakes in the past. In fact, coming in before the pandemic started, value stocks actually started to do quite well in late 2019. Our portfolio responded. And then there was a shock to the system, a flight to safety, back into large cap growth stocks, and that affected us. So let's look at page 12 at some of the numbers in the markets. Here you'll see a lot of investment returns, but if you focus on the spreads between value and growth, you'll notice that in large cap, at the top, the value growth spread year to date is very significantly valued. For the trailing 1 year also, favoring value. The value indexes have outperformed the growth indexes. But for 3, 5, even 10 years, the spreads are still pretty negative, even 15, frankly. Still quite negative for growth over value. When you hired us, it wasn't anything like this. In fact, there was a long-term premium for value over growth. So the metrics have definitely changed. And as you'll see in the next couple of slides, there tends to be a variation that goes up and down over time. Look at small cap, and you'll see that the spread's also pretty significant year to date in favor of value. And the 1 year number even bigger for value over growth. So we're starting to see a turnaround. Post-tech bubble, when value stocks really suffered, there was a dramatic recovery pretty quickly over the next several years, and that's the early part of our track record. You really benefited from that as you hired us just post-tech bubble at a time when, frankly, not a lot of people were hiring us in 2001. And we saw a pretty quick rise in recovery in value stocks there until about 2007. There was a great run for value, and our portfolio started out very strong in the early days. Let's look at the next slide. This is a sort of value growth comparison, just looking at the indexes, taking the Russell 2000 small cap value minus Russell 2000 growth or small cap growth over time. And these indexes are supposed to somewhat mirror each other, basically half in value. And you'll notice in late 1999, the worst ever experienced for small cap value relative to growth, the 3 year spread was almost 21%. Very significant. So you hired us in 2001 as that line was already starting to recover, but look what happened to it. By the time that recovery finished, and the pendulum seems to always swing too far, value would outperform growth on a trailing 3 year basis by 31.6%. So those early years were quite good for value. That remained pretty consistent for a while. You notice the line sort of right around 0, plus or minus, and then you see another dip there at minus 13.3. So the second worst experience in the history of these indexes just occurred in about 2020, and now it's recovering. The long-term average of rolling 3 years is for value outperforming growth by 2.8%. So being minus 13 or minus 20 was pretty significantly away from the long-term average, and being plus 32 was certainly way above the long-term average. Today, we sit at a 3 year of plus 4.2. So things are turning around in small cap, and it started in small cap first. Because of the invasion of Ukraine, the large cap indexes have not followed as long as fast. If you look at the next slide, you'll see the same 3 year analysis looking at the large cap indices. In here, the tech bubble in the recent period in 2020 had similar underperformance for value relative to growth. So this kind of illustrates that cyclicality I was talking about. Again, you hired us in 2003. You saw that quick recovery and outperformance for value over that period. The long-term average now on large cap stocks is about flat, minus 30 basis points actually for value. And we're seeing a recovery again now, so things are improving again, and that's certainly what we're seeing. The last year, though, has been quite volatile. You see that little dip there, and that we actually started out this year really, really strong in January and February. And then with the invasion, what we saw is energy prices go up dramatically. We saw a little bit of fear in March, and growth stocks actually did really well in March. So we kind of gave back a lot of our initial excess return in the first quarter, and that's been coming back so far in Q2. So let's take a look first at the small cap portfolio. If you go to page 15, and we'll talk about this effect of compounding and excess returns over a long time frame. Back in 2001, we started with $9.5 million. You've been able to take out $16 million over the years to be able to pay benefits, rebalance your portfolio, etc. And then at the end of April, the portfolio stood at $31.8 million. So that's a net return on investment of $38 million, which is pretty strong. Our, again, benchmark here is the Russell 2000 value. If you go to page 16, you're going to see that entire history. So we started, if you go to the since inception numbers in the gray there, I know the numbers are small, hopefully you can see them a little bit better than I can with my readers on. But at 9.7% annualized return, think about what's happened over the last 21 years. We've seen a lot of excitement in the markets, ups and downs, a lot of a near financial system collapse. The recent episodes of a pandemic that we haven't seen in the 20s, and yet you still have nearly a double-digit return net of fees since inception, and that return is higher than both the Russell 2000 value and the Russell 2000. What does that mean on a compound basis? That means this portfolio has risen 587%. That's why you've been able to withdraw so much money, and why there's still a significant portfolio there for you. We've done that with a similar level of volatility. Looking at performance year to date, I'm going to give you an update because May has been really strong for value. So the portfolio through the end of April was down 7.4. It's now down 7.9, so it's down another 0.5% or so this month. But our benchmark, which was down 10, is now down 12. And the core benchmark, which was down 16.7, is now down 19.8. So the portfolio is really holding up well in this downdraft. Value stocks are holding up much better than growth stocks. People are giving up on some of the stories of companies that never made any money, like Peloton and others. And those stocks are selling off much more dramatically because there's no earnings there to support those stocks. Our trailing one-year numbers also quite protective. We're very hopeful that we're starting to see an earnings-based potential recession, which is something we saw back in 01 and 02, and that was very favorable for value. So if you look at those early years, we did really well in 2002. The market was off a lot in 2002. We were up 3.8. There's no way we were up 1.6 in 2003, so that number's wrong. It looks like everything's off a year, because we weren't up 40 in 2004. I'll get those fixed for you. But long term, the numbers at the top of the page are correct. Last year, 2021, we were up 35 in small cap, and this year, again, 2 years in a row of excess returns. And if you look at page 17, you'll see that the portfolio trades at a substantial discount to the benchmark stock. So 216 stocks, very diversified, no big bets in any one industry or sector, and your portfolio trades at a PE of 8 based on earnings forecasts for this year, which are likely to come down some. The FY2 forecast is 2023. That update there is 7.8 times, so a substantial discount to the Russell 2000 value, which, by the way, has a pretty significant part of the index in companies with negative earnings, which did well in 2021. So those negative earnings companies are the ones that are not doing as well in 2022. And our focus on quality has really helped hold the portfolio up much better than in the overall market. On page 18, you'll see the kind of history of our product. If you look at that discount today, that discount's pretty significant, between about 40%. But you can see that in 2020, we were at a 57% discount. And way back coming out of the financial crisis, we had a 66% discount. So we always have a discount to the benchmark. When that discount is bigger, the excess returns that we see tend to be higher. You're going to see the same pattern in our large cap product. So our hope is, with this focus on quality and low expectation companies, 8 times earnings is low. If this portfolio goes to 10 times earnings, that's a pretty significant outperformance relative to the benchmark. So we're optimistic that the companies we hold have a lot of potential to deliver good excess returns. On page 19, you'll see the weights by sector in the small cap portfolio. You can be plus or minus 5%. Probably more importantly is what you see on the next slide, which is the attribution over the last year. So we had outperformance of about 5%. You can see that we didn't get much of that from our sector allocation. Look at the sector returns in the last year. Energy stocks were up almost 70%. A dramatic rise in oil price really boosted that sector. Many of those companies were losing money. Now they're starting to make money. Notice the rest of the sectors. Only a couple of them are positive. So very wide, a big variation in returns by where you were in the market. It really mattered a lot. We happen to be underweight energy. One of the reasons is a lot of those smaller energy companies, frankly, weren't making any money. So needing to see cash flow is something that we're moving into that area now, but slowly and cautiously, because it's come up so fast. But we've been underweight there because of the lack of quality and lack of earnings from a lot of those companies. And that was our biggest problem from the sector perspective. If you look at earnings, you'll notice the middle section of numbers there, it says EP quantile. That's earnings to price ratios. So companies that lost money is that first set of numbers. 23.5% of our benchmark is in companies that lost money historically. You see we have a significant underweight there. Those stocks had done really well in 2021. They're not doing well now. If you look at forecasted earnings, you'll see that 13% of the companies, so a lot less are forecasted to lose money than lost money historically. And that is a variable that we actually put a lot of emphasis on, so our weight there is almost zero. But those companies, again, even those that are forecasted to lose money, finally the market's recognizing that could be a real challenge for them if we did go into a recession. So some of the key elements that we look for in companies have started to pay off, and that's been helpful in seeing the excess returns in the small cap space. Since it's the same process and the same team that manages both portfolios, I'm going to go on to the large cap strategy, and then I can take questions at the end. Is that okay?
Perfect.
Well, let's take a look at page 23. So starting in 2003, your portfolio became a $22 million allocation. And here you've been able to take out $32.6 million. Return on investment is $48.5 million, essentially. And then you have a portfolio at the end of April of $38 million. So benchmark here is Russell 1000 value, but remember how that cyclicality went in terms of performance. If you go to the next slide, you'll see the results. Our returns here, pretty similar to the benchmark looking 3, 5, and 7 years, but that's coming off that trough that I mentioned. Year to date, our portfolio a little behind in April. It is ahead now by almost 100 basis points. So through Monday's close, we're down 6.8. So the same return that you see there. The benchmark, though, is now down 7.5. So it went from 6.3 to 7.5. And the S&P went from down 12.9 to down 16.1. Pretty significant sell-off in the overall market. And again, your portfolio really hasn't moved. So that's a good sign. 2021, if you look at the lower left corner there, we had a good year there too. So we had hopefully 2 years in a row of good excess returns relative to the benchmark as value stocks recover. And in the large cap space, you're dealing with not just valuation discounts, but you're also dealing with a size that may be in the portfolio. And we have that. So if you look at the next slide, your portfolio trades at less than 10 times earnings, so a little bit more expensive than in small cap. But the discount here is actually very big. compared to the Russell 1000 value. Much less negative earnings companies in the large cap space than we see in small caps. The dividend yield at 2.7 is quite high, so there's your treasury yield. Trading at a pretty good discount on cash flow as well compared to the benchmark, 153 names. And notice that the weighted median market cap is quite a bit smaller than the benchmark. So kind of being able to go anywhere, buy the best ideas, still have a portfolio benchmark to large cap, but that gives us the ability to sort of go anywhere, and we're not necessarily focused on the largest names. In fact, some of our biggest exposure bets are not owning some of the larger names in the benchmark. The other unique thing about this recent environment with growth doing so well relative to value until recently is when Russell rebalances their indexes once a year, they try to put essentially the same amount of company, or weight, I should say, by market cap in value as they do in growth. And with growth outperforming significantly for 3 years in a row, last year when they did the last rebalance, they included companies like Salesforce.com in the value benchmark. Companies like Google are in the value benchmark. So the value benchmarks become more growthy, and that's one of the reasons our portfolio discount is actually bigger than it's been. Not because we changed, because the index has more growth exposure in it. And that's something that we think going forward will be good for our returns. On page 26, you'll see the history of the valuation here. So here in 03, you notice that discount was a little bit above our long-term average. By the time we got to 2007, it was the smallest discount we saw relative to the benchmark. And that's right before the financial crisis. It's been steadily rising since then, peaked at 37%, roughly the same level that we saw back in the tech bubble. It's still very high in large cap, much higher than we see in small cap. So the long-term average here, about 20% discount, we're at about 36 today. When we look at periods where that discount's been 36 or higher, like we're seeing now, and you look at what the expected, or what the actual return was, I should say, going forward, the excess returns that we saw when the discounts were big were the highest. So here we have a longer track record than we do in small cap, and that's very encouraging to us. When the discounts are large, the excess returns tend to be larger. And like you saw and remember in that line, post-tech bubble, the damage that value had during the tech bubble came back very quickly. It just took about a year. So these styles are very volatile, very difficult to time. That's why you have exposure in both. And in our portfolio, we think is poised to do quite well looking forward. On the next slide, you'll see the sector allocations here. Again, we tend to be within 5% market weight. One of the areas we really like and we've been adding to is healthcare, the second sector there. It's been rising in our benchmark, and we're liking those stocks a lot. They're generating a lot of free cash, very high dividends. Those stocks have really helped protect us. And if you look at our top 10 holdings, you see Merck, you see Pfizer, you see Bristol Myers, so you see a lot of the healthcare names there. But more importantly, unlike what you saw in small cap, if you look at our top 10 active bets, that's the table below there, we don't own Berkshire Hathaway, United Health, Procter & Gamble, JP Morgan, Chevron. So some of the bigger stocks in the benchmark, we have a zero weight. And some of those weights in the benchmark are actually quite big for the companies. You don't really see that in small cap. So we've got a little bit higher bet sort of against the names that we think are too expensive. And we're much more overweighted names that we feel have a much higher potential for expected return going forward. The same attribution I showed you earlier is going to be on page 28 with one addition. I added a size variable because we don't have a size variable in small cap, but we do in large. Notice by the sectors at the top there over the last year, the energy sector, 61%. We're underweight here too. Again, we've been adding to Exxon here recently, getting closer to a market weight, but we've been building that position. Some of the larger oil companies were quicker to make money than some of the smaller companies. We've been overweight refiners then, and refining companies haven't done as well as integrated oil companies or exploration companies. So we have underperformance in that one sector. The other area is consumer discretionary, where we lag a little bit there. If you look at earnings, 5% of the large cap index had earnings that were negative historically, and only 2% are forecasted to have negative. But if you look at sort of the cheaper stocks in the bottom quantiles there, you'll see that our overweights are significant, and that our stock selection generally should be good in that area. It hasn't panned out that way over the last year because it's been a really unique year in large cap. We had 6 months that were phenomenal for value and 6 months that were phenomenal for growth. Very, very wide swings. We didn't see in small cap. And we didn't do well when growth did well. We lost a lot, but we did really well when value did well. So totally an unusual 1 year period to look at because of the way the market sort of panned out. It looked like, according to the indexes, value did better than growth over the last year. Not by a huge margin, but there was really wide volatility over the last 12 months. And this is sort of trying to capture all of that, so it's a bit noisy. I do have a list of our holdings behind both sets of data, and then a list of our clients in the back of the book. And I'm happy that both portfolios have really recovered in terms of recent performance. Are there any questions? I think it looks like I've taken about my half hour here.
I don't think the board has any questions called. Does Willis Towers Watson have any?
Oh, no questions from me.
So yeah, I have one. So both the plans are in value, the large cap and the small cap,
Yes.
but we're holding some less traditional value.
And your holding stocks that are trading are much cheaper than the stocks that are in the benchmark. And the small cap benchmark in particular is being affected by the companies with negative earnings.
Mm-hmm.
So the valuations look higher because 20% or so of the index is in companies that don't make any money.
And
So for all the earnings of the 1,000 companies that are in the 2,000 value, you see that with that many companies not making any money, those that do have earnings inflates sort of the PE on the small cap index.
And some of the companies you said have been basically listed as value versus growth.
That's right. So
Google actually would be considered a value stock.
exactly. Every year the index provider, Russell, in June, they recalibrate the index. And in small cap, the turnover is high. In fact, the Russell 2000 value last June, I think the turnover was 20 to 25%, very high, all at one time. So we have a whole set of new constituents to compete against, essentially, every year. In large cap, that turnover is lower, but it is there. So you have, Google wasn't in our benchmark 3 years ago. Salesforce wasn't in our benchmark 3 years ago. Those are companies we would certainly consider growth companies.
Right.
Not traditional value companies. So that should give us a leg up in the sense that looking out from here, if value does do well, and those are closet value stocks, if you will, and they don't participate, that should give us, the ability to outperform. And then they'll start to reset the index the other way as value stocks do better.
Okay, thank you.
Of course.
I have a question on what are the consumers going to do? You see like Target took a big hit, Walmart took a partial hit. Is this the future for the rest of the year?
Potentially. We had a couple of companies report earnings and talk about how their expectations going forward are going to be lower, or that their cost of delivering goods to the stores was higher than expected because of the price of transportation. That has definitely caused companies to come out and lower their guidance for the remainder of this year and maybe even lowering it for 2022. That has a much bigger effect on a company whose PE is 20 than one on a company whose PE is 8. In fact, yesterday there was an earnings announcement from one of the companies, Dick's Sporting Goods, who missed, but the stock went up. So if you look at, I think sometimes the expectations get out ahead, and when the companies actually go and report, and it's not as bad as maybe people thought it was going to be, the market reacts favorably. So it's really difficult to sort of predict what the market's going to do. But when you own a basket of companies trading where expectations are low, remember, across both portfolios, we're buying a lot of stocks who don't have high expectations. So people have already given up, so to speak, on these companies. So it's not a terrible situation they have temporary higher costs, especially if they're good operators and they continue to generate a lot of good free cash flow. So that's the important thing to us. And if they miss and things do deteriorate, if you see same-store sales really decline across the board, and that you compare that to other companies, that would be a loss of momentum in our model, and the ranking of that company would go down. So even if it stayed relatively cheap, there's a possibility we would get out. One of the companies that we own in large cap, Kroger, that actually had earnings already announced also that their costs went up dramatically, and grocery stores don't have a ton of margin. That's been one of our best stocks over the last year. We've been trimming back that position this quarter.
Thank you.
Thank you. Any other questions? All right,
Thank you,
sir.
James.
We appreciate it. Thank you, James.
Great, thank you guys, great to see you all. Have a great rest of your meeting, and again, thanks for your business, we appreciate it.
All right, up next, we got Cole, Jacobs, and Zachary from Willis Towers Watson.
Thanks, Eugene, and good morning, everyone. Just a few quick updates from us today. We'll review capital markets on slide 4, and then the plan's performance review. And then next meeting in June, we'll look to have a more kind of strategic review that we've discussed a bit about in the past. But to look at capital markets here, we show some of the data points for the first quarter of the year. And this has changed a pretty good bit through the end of last week, but you can see in the top left, the S&P 500 for the first quarter was down 4.6%. Rising inflation, a hawkish Federal Reserve, Russia, Ukraine situation, all kind of weighing on returns there. Small cap stocks did a little bit worse than their larger counterparts. They returned minus 7.5%. And then international emerging stocks down about 6 or 7% there as well. So we're seeing some negative returns there for the first quarter. Looking on the right-hand side of the page at fixed income markets, similar story. The aggregate index at the top there down 5.9%. And then the longer duration securities, the long government, the long credit, both down over 10 or 11% there. The reason being yields have come up significantly thus far. As inflation has come up, the Federal Reserve has indicated that they are going to tighten monetary policy. They've raised interest rates, and so therefore Treasury rates have also followed suit and have risen. And you can see that in the bottom right-hand corner. The blue line is the Treasury rate curve as of the end of the year, and that pinkish purple line above it is the Treasury rate curve as of 3/31. So you can see how much it's risen and how almost parallel it is from about the 2-year all the way to the 30-year. It's sitting at around 2.5%. It has increased a little bit since then. The 3 years close to 3%, and the 10-year is about 2.75 right now. So it's not quite as parallel as it looks here, but still has increased pretty significantly so far this year. Some of the economic data, as you know, headline inflation remains at a 40-year high, 8.5%. GDP growth remaining pretty strong numbers there, 6.9%, and then unemployment rate continuing to really trend down, 3.6%. Really tight labor market. Companies are competing for talent, so that's positive news there. All of these trends essentially have continued during the second quarter of the year, which it's only been about 2 months now, April and May. But through the first quarter, the S&P 500, as I mentioned, was down 4.6%. Since then, it is down an additional about 14%, bringing the total year-to-date return of the S&P 500 to around down 18% for the year. So we've seen just increased volatility in markets, especially in the growth segment of markets, and James just discussed this a little bit, of course, but growth is, given that kind of higher duration, more sensitivity to interest rates there, those stocks have fared worse than their value counterparts. So the growth index is down 26% year to date, and the value index is down only 8% year to date. So really seeing a divergence there with value-oriented stocks that make money, high quality, et cetera, being favored by investors in this market environment. Any specific questions on capital markets before we switch to plan performance?
Nope.
So looking at plan performance here, this is also through the first quarter, so we'll kind of look at the 3-month column or the year-to-date column, same information. The total plan returned minus 5.5% so far this year for the first 3 months. That is below the benchmark of 3.4%. So we saw negative absolute and relative performance, primarily due to the managers in the growth segment and the overweight in the growth segment. As to be expected, got hit a little bit harder in this market environment. So you can see LSV, who we heard from, down 2% versus their benchmark of 0.7. That has improved since then, as James mentioned. They have protected on the downside a little bit more as of recently. And then sustainable growth advisors, so your big growth counterpart, getting hit a little bit harder as expected. They're down 11.7% so far this year, and their benchmark is down 9%. The main rationale for that underperformance actually is the energy markets. It's actually going to be a similar story with Mower as well, but they don't own any energy names, and the energy sector was the only positive performing sector in the first quarter. So that in of itself limited their performance. Small cap segment, it was down 5.8% versus 7.5%, so it actually did a little bit better. LSV protecting on the downside, as you can see, and continuing to do so. And disciplined growth investors performing pretty well as well, even though it's negative 10% here for the first 3 months. The index was minus 12%, so they did protect about 2% there, despite the negative absolute numbers. And then lastly, just rounding out on the international equity segment, Mower, pretty disappointing results so far this year, minus 11.6% versus the benchmark of minus 4%. So they suffered worse returns than their benchmark. Also, mostly due to the fact that they do not own any names in the oil or many names in the banking sector as well, which also performed better than the others. So that limited their performance.
Don't they have a little bit in Russia, Cole, that they were
They
trying
do.
to load?
They had a very small position. I think it was less than 50 basis points in that TCS bank, and they have written that down to 0. They actually didn't have, because it was such a small position, it didn't have a huge impact on the portfolio, but it did have an impact.
Gotcha.
Yeah.
Cole, with sustainable growth advisors and more, what's their reasoning for not owning energy and for more also not really having much of a position in the financials?
It's a good question. So part of it could be ESG related. I think a lot of these managers are looking at that a little bit more carefully. So it's not to be exclusionary, but to limit some ownings or some ownership there could be a piece of that. Another reason would be that a large part, and I know SGA thinks this way, The cash flow generation from oil and refining is very cyclical, and it's hard to predict because it's certainly based on commodity prices versus, fundamental, just fundamental metrics in the market. So for that reason, they don't prefer to own kind of any kind of cyclicality, in any names that can kind of move up and down, just based purely on commodity prices and not fundamentals. So they prefer to have that more quality earnings that they can rely on quarter over quarter and year over year. So a mix of those two reasons could be why they exclude some names there.
Okay, I think I'd like to have conversations with them about that. I mean, we didn't hire them to be ESG managers, and if that's what they're doing, I don't remember them presenting themselves that way. I understand what you're saying about the cyclicality of earnings for some of these companies, but to me that's a different reason than if they're doing it for some sort of ESG concern that we're not aware of.
No, totally understand. And I wouldn't say they're ESG managers. I would just say that they do look at some names through that lens.
Right.
But they're not excluding names for that reason. That's just a factor that they place on their investment thesis. But I know with SGA specifically, and with more as well, it's a large part of that is just the cyclicality of those names. I mentioned Mower had less exposure to banks, and that was the reason for their underperformance. That's also a very kind of similar story there, given that most kind of banks, their earnings are dependent upon interest rates, which also don't have an inherent value like commodities, and so they prefer to own names that are not kind of based on these factors that don't have any inherent value to them.
Is the inflation driving the energy?
I think the Russian situation is driving oil prices to some
Right.
extent.
Yep.
So, yeah.
Yep, that's right.
Doesn't banks excel with interest rates rising, and they're not there?
Well,
Yeah, banks do.
Yeah.
Yeah, they do much better in a higher interest rate environment.
That would
So-
take time to see that, I would imagine, right?
It would, but some of, it depends on how much of their book is floating versus fixed. I think I'm always surprised at how much is floating, actually. So it would take time, but they also would see, a revenue increase immediately as well.
Especially in the consumer credit side, there's a lot tied to floating rates.
Yep. Yeah, exactly right.
Or
So yeah, I don't want to
balance
speak
sheet.
and, kind of blanket, ESG as the reason here, but I would probably focus more on just the general cyclicality of those sectors and how they prefer to have higher quality earnings.
Thank you.
So rounding out the income segment here on page 6, it fared much better than the growth segment, as we would expect in a period of heightened volatility. The segment overall returned 1%, so just slightly below its benchmark of 1.3, but in positive territory nonetheless. And that has continued so far this year, although we don't see it on this page, but in April and May as well, this income segment is certainly protecting on the downside, so that's been beneficial. Within the alternative credit, the Ares High Yield Fund performing better than its benchmark year to date, just slightly, even though it's in negative territory as interest rates have risen. Longer term performance is good there. One Sharp, we've heard from recently, continuing just to earn, that 6 to 7% per year, resulting in about 1.5% a quarter, and that's what they've done here despite the volatility. So, really positive performance there and kind of doing what we expect them to. Libra Max kind of right at their benchmark. Keep in mind this is lagged by a month, but no concerns there. And then BNY Mellon also, a high yield fund as well, so a little bit below its benchmark year to date. So we'll keep a close eye on them, but more structural performance driven there. And then the real estate segment held up really well. Really, the portfolio really benefited from that this quarter. Principal return 7.3, just slightly underneath the benchmark. And Harrison Street performed 2.6%, a little bit below the benchmark, but you know, they complement each other well, and they play in different parts of the real estate market. So all in all, you know, performance at minus 5.5% for the quarter is, you know, pretty in line with expectations given the volatility that we've seen. So we'll have another update at the next meeting, of course, but income segment is helping to kind of mitigate some of the volatility there. And you know, the value managers are kind of holding up well as some of the, you know, hot air comes out of these growthier names in the equity markets. So happy to answer any other questions, but that's all I have prepared for today.
Anything?
Cole, just a quick, concerning the two new managers, I expect we'll get some sort of a funding call at some point. You guys will notify us about that, and, you know, we'll arrange it through State Street to fund those manager accounts.
That's exactly right. Yeah, you mentioned earlier, you were spot on. You are in the queue for both of those managers, and the queue is about 1 to 2 quarters in length. So as they progress through deal flow, they will move along that queue and call your assets, and you know, they expect to be 1 to 2 quarters, and we'll have, you know, a bit of time to deploy those assets. So once they call the assets, we'll have probably a few weeks to a month to deploy those assets, so we can look at where we would like to source that from. But it probably will be in the second half of this year.
What are the two again?
The Harrison Street and Nuveen Industrial Fund.
And the Harrison Street, that's separate from the current fund?
That's right, yeah, it's a social infrastructure fund.
Well, hopefully they're down now. We'll get them cheaper.
What you're buying was cheap.
What's that? Yeah. Well, whatever we gotta sell to buy. We don't have the money just off to the side, right? In cash. We'll have to sell something.
No, it'll come from another manager. I mean, there might be some in cash, but we'll definitely have to determine where to take it from.
If you had to buy it tomorrow, where would it come?
I'd take it from whichever managers are down the least. But, you know, having said that, you know, I probably look at the specific portfolios for the managers. It's not just where they've been, but where you think they're going. If you think growth is going to recover, then you may not want to take it from growth. But if you think growth is going to continue to underperform, then that may be where we take it from. If you think value is going to continue to perform, then you don't want to take it from value. But, you know, I'd talk to the managers, look at their portfolio holdings, and based on that, decide where I think we, you know, should take it from.
And we don't traditionally vote on that.
No, you kind of leave it to staff and the consultants to make those
But
decisions.
you do talk to Cole and everybody.
What's Cole's read?
What do you say? What does Cole think?
On sourcing? Yeah, I think it would depend on what markets look like when the capital is called, but you know, as it stands right now, you are overweight large cap and small cap. So you could take it from, you know, Vanguard, just the index provider there. You've got plenty of money kind of sitting in, you know, just that core passive option. So you wouldn't disrupt any of the active managers. I think active management is really important in this market environment right now. So that would probably be the first place I looked.
And it's important to note too that, you know, we've made these commitments to these two new managers. Unlikely will receive full calls all at once. So we'll likely receive, a call for, a portion of the commitment initially, and then at a subsequent quarter, another call. And so we'll look to meet those calls while keeping the portfolio in line with the policy targets that we discussed previously. So to the extent, as Cole's kind of noted, to the extent that the portfolio is above or below policy target weights, that will kind of inform how we recommend meeting those capital calls as they come in.
I didn't know they did that. They do it in partial sometimes? Okay. Awesome. Well, thank you. Any other questions? Thank you, Cole and Zach.
Thank you all. I'll drop off now and hope everyone has a great rest of your day and a good Memorial Day as well.
All right, be safe. Thank you.
Thank you.
Guys.
All right. Up next, we got the, oh, we already did that. All the old businesses through. New business, investment rate of return assumption. Forecast. We have the actuary.
Yeah, we have Joe Griffin
Joe
from
here.
Foster and Foster, and just as way of an introduction, we were doing an experience study on the pension plans with our actuaries, where they look at various factors that the plan has experienced over the historical timeframes. And part of that is looking at the returns, and both historical and expected returns based on various asset class outlooks that they get information on from consultants and other actuarial organizations. And so they've come back with a recommendation that we lower the interest rate assumption, and I'll let Joe walk you through it. The bottom line is, on the general employees pension plan, we're recommending, and we're going to lower the assumption to 7.75 from 7.9, and we're recommending the same thing on this plan.
We're already at 7.9, right?
Right.
So we were gonna go to 7.75.
7.75, and they continue to look at it, and if we think we need to lower it further in the future over the next year or two, then we can have those discussions then. But Joe can walk you through it. A lot of this is in response to feedback that the Division of Retirement has given to other plans around the state of Florida.
They're still gonna give us a little grief for the 7.75 though, but
Well,
with our unfunded liability being,
and remember,
right?
most other plans in Florida aren't invested like we are. They don't have the same asset classes, which over the long term, we expect to generate higher returns.
Correct.
So, a plan that's 50% or 30% in fixed income, core type fixed income, there's a reason that you don't expect those plans to generate 7% return. But we're not like that. But Joe, go ahead and walk through if you'd like.
Sure, William, can you guys hear me okay?
Yep.
Perfect.
Excellent. So yeah, just to remind the board, the investment rate of return assumption is the most important assumption in my eyes that we make. And pensions are funded in one of two ways. One is through contributions, whether it's the state premium tax, the employees, or the city. And the other way they're funded is frankly through investment returns. And, most people don't realize that anywhere from 60, 70, 80% of the pension benefits are actually funded through the returns. And so I consider it one of the most important assumptions to make. If you lower the investment rate of return assumption, you're essentially estimating that you're going to have lower returns in the future, which means on the flip side, your contributions will have to go up. Now, just for a bit of history, back in 2012, this plan was assuming an 8.5% return. There was analysis done at that time, and the board decided to step down from 8.5 to 7.9. And you did that by 10 basis points a year until we hit 7.9 in 2018, and we've been at 7.9 for 2018, 2019, and 2020. So the recommendation that we're coming with you today is going to be for the October 1, 2020 valuation,
that we're currently working on. We're still collecting some financial information from staff to complete that. But in the meantime, we were looking at the assumptions, and as Williams pointed out, the Division of Retirement in their most recent state acceptance letter basically asked the board to take a look at this, that they felt that they're a little high. So one of the things we did for staff to help them out is we looked at the consumption and three alternatives that we thought were reasonable and within the scope of your investment policy. And as William pointed out, your plan is a little bit more aggressive than most throughout the state with your equities, which in turn leads to a higher return. So I would expect that your assumption will always be, if you continue with your investment strategy, at the higher end of those within the state of Florida. So what we did is we projected out over a 5-year period these various assumptions, calculating contributions for fire, police separately under each of these. And we did one other thing that we're recommending as part of this review is fresh starting your assets to the market value as of October 1, 2021, and then using what I would consider a more preferable method for calculating the actual value of assets, which will look at actual returns versus expected returns and smooth those over a 5-year period. The current method just projects the actual value to the end of the period and then takes a 20% move towards the market. So the first method that I mentioned was preferable. So we've generated, exhibits A1 through D4 really to kind of help you and city staff and finance understand the financial impact of making this change. We feel that an assumption anywhere from 7.25 to 7.75 is reasonable. And if you look, William, at page 2 of this letter, what we did here is we collected information from a study that Horizon Actual Services compiled every year. And what they do is they go out to Willis Towers Watson, in Callan, and all the investment shops and ask them for their capital market assumptions. And they get 10 and 20-year time horizons. And so we took a 20-year time horizon, we applied it against your asset mix to come up with what we thought was a reasonable expected return assumption. We made a couple adjustments for your inflation assumption versus what they used in that survey. And then we also added 70 basis points for your historical manager outperformance. So when we went through all the math there, we ended up with a 7.91% expected return. You might say, well, why don't we just stick with 7.9%? Sorry, is there a question?
No, I was just saying we're right on target then, 7.9, right?
Yeah. You might ask yourself, why don't you just stick with 7.9%?
All right.
Well,
Joe, I was here in 2012 when you last time did that, and I think that you guys were talking about a long-term 5% return around in the market going forward. Do you guys remember that discussion?
I think Willis Towers Watson was talking about
Yeah,
that.
not Joe, I'm sorry, but yeah. So lower your expectations and you'll never be this, sad.
Yeah, Willis Towers Watson told us we'd never see double-digit returns in the stock markets
Right.
again.
That's what I was gonna say. I distinctly remember that we'll never see another double-digit return.
Mm-hmm.
On 12, yeah.
Under promise, over perform. I mean, that's not an actuary's job, that's a consultant's job. Okay, Joe, I'm sorry.
No, that's okay. So you might ask why we didn't just say, let's stay at 7.9. Well, there's a couple reasons. One, there's a general trend, not just in Florida, but throughout the country, of expectations being lowered by investment consultants. But two, the actual standards of practice have kind of dictated for us to be a little bit more conservative than just the 50th percentile of the median. And our analysis does include 70 basis points for expected manager outperformance. So I felt that somewhere from 7.25 to 7.75 was a reasonable assumption. And there's not one answer here. I know 7.9 sounds like a very good answer. There's not one answer. It's a range. And so when we have this assumption, it's with consultation with your investment consultant, with the board, to really just come up with our best estimate. And I think what staff would like the board to consider is 7.75. I would be comfortable anywhere from 7.25 to 7.75, based on the analysis we put together. Division of retirement may not like that, but we put together what I feel is a strong analysis, and the way that they work is they probably won't be reviewing this for another 5 years anyway. We may have already looked at the assumption again. They actually looked at it, but in the backdated acceptance letter, they did ask the board to look at that, which is kind of what I bring it forward today. We'll pause and ask if there's any questions.
I got one. I'm looking through I guess you call the appendices, the exhibits, and no matter what it goes to, for the next 5 years, we're expected to be over 100% funded. And my question is, when the last bond issue was in 2003, I believe, or something like that?
No.
2020.
Yeah, just a couple.
No, not the most recent one, one previous.
Oh,
The oldest one, yes.
And it went, this would be a 1/4 of that period of time the other went through. We went down to like 76% or something. So I just questioned if we're going to stay above 100% for 5 years.
Well, we hope so, but I mean,
do too, but so.
you know, the assumption is, I mean, that
It's an assumption.
that's using the assumption. The reality is, I mean, right now, we're down, 5%, over 5% for the fiscal year to date, and that could be worse by the end of the year. It could be better, but
Well, the
we're
reality
not
is
guaranteed to stay 100% funded.
we may or we may not, but now you've also funded, let's say you create another, unfunded liability that's 5 or 10% of the plan. You've now funded 90% of that liability at 2.5%, and you're funding 5 to 10 of it at 7%. So, yeah, you may very well be, and I'm sure over the next 10 to 15 years particularly, you're going to generate another unfunded liability. But the point is, even if you do, you're well ahead of where you would have been, and it shouldn't be a concern.
Yeah. But it'll look relatively like a bigger impact, and that's the problem with well-funded plans, is when you see a 10% drop, it goes from 100 to 90, looks much worse than going from 40 to 36% funded, because you're screwed in both cases in 40 or 36, right? So the worst funded plans, when the financial crisis hit, were the ones that looked like they took the least amount of hit to it, but it just meant you were even that farther underwater than you were before. People don't get that.
But you've also really got to focus on what are you paying for that, for those pieces of that unfunded liability. Any piece you generate going forward, yeah, it's going to be at whatever we choose at 775. But everything else in your plan is 2.5%.
And that was like payoff for the previous one, like refinancing it.
Yeah.
Well, we got to go down, because the state's never going to get off it if we don't,
Hey, William?
Yes.
I heard some mention of the issuance back in 2003. There is one key difference of the timing of when we issued the POV this time versus last time. There's a key difference in state law, which basically says that you can never kind of take a holiday or a credit for overfunding. So the plan will always have to at least contribute the normal cost plus the expenses into the plan, even when you're over 100% funded.
And Joe, what year? What year did that go into effect? Around 12, maybe?
Yeah, around 2012 or 2013, I can't remember the exact year, but it was around 10 years ago.
And that's what we're doing currently. The sponsorship.
Until recent years, there was never any administration around here that would even consider taking a holiday.
Yeah, I only know what my predecessor said. They said they never took a holiday, but they said there were some pennies on the dollar, but I don't.
Yeah, they have a much different take on it than the finance.
So the city's got the money to pay for this?
Well, if you're asking me, yeah, the city will always come up with the money to make a contribution depending on whether the rate is set. Whether the rate is set where I would set it is an entirely different question. Let me back up. I understand the practicalities that we're going to have to go down because of what you just said is correct. I don't agree that our rate should be lower than 7.9%, but I didn't agree that we should have been reducing it from 8.5%. It's just, that's the political reality.
If we don't reduce it at all,
Yeah.
they're just gonna give us grief every
Hold on one second.
report.
So basically, the standard feedback from the division is that you should look at your rate of return and consider lowering it. That's what they tell everyone, And that's part of the reason we did this. But it was also time to take a look at all of our assumptions, which Joe is still working on, some of the other ones. But, to me, that yes, they say that we should take a look at it every year, but they've never rejected a vow because our rate was too high. Now, is it possible that might happen at some point? It is, but, and that's another reason that we're taking a look at this now to sort of prevent that from happening. And, to me, 7.75 is, so we reduced our rate from 8.5 to 7.9 by 10 basis points a year. So here we're recommending going down 15 basis points in a single year, which is more than we've done previously. And, we'll continue to look at it. The board can choose to lower the rate every year if it wants to. But I don't think we need to do a large rate decrease all at once.
And it is an expense, you're right, it's an expensive proposition.
0.75 to 1% payroll.
You have numbers on that?
I'm sure Joe's got it.
Yeah, they were in
In the attachments.
Attachments, yeah. So if you go back to your email, you have to just scroll through Joe's actuarial speak and get down to the numbers. But, I understand the realities of the division of retirement having some sway over this. But at some point, if you're going to continue to let the state tell you how to manage the plan, you need to take a look and deleverage the risk within your investment policy too, to reflect the realities that we're chasing a lower number, and do we need to be as heavily in the equity markets as we are. I think that was Joe's point about other plans with their 30% fixed income and those other type of segments. I'm not saying that we need to do that for this 15 basis point reduction, right? Because it's served the members well over the history of this fund. So, remember, 5 1/4, I think, is what the target we should be shooting for over the next 5 years. Kidding, but.
Risk-free, we should be moving.
That's right. 30-year treasury. Right.
Well, how to be having 30% bonds help you right now?
Although it seems untraditional, according to Bob, we're a small enough board, and I'm a voting member, so I'll move that we reduce the investment rate of return assumption to 7.75%. And there's a second. Under discussion. So this would be effective.
So it would
fiscally.
They would apply it to the fiscal year 21 actuarial val. So it will, if it has a financial impact, it will have that impact on the fiscal year 23 contribution rates for the city.
Okay. Any questions, Liam? Steve? Call the question.
I second it. How about that? Did nobody second your motion?
No, he already did.
Oh, did he? Okay.
Already did. Sorry, for the record. Yeah. All right. All in favor of the motion? Aye.
Aye.
Any opposed? All right, motion passes unanimously.
And just real quickly, Joe, while you're still on, I was going to give a very quick update to the board about the Division Retirement Annual Report. We did receive draft financials last week from the external auditor who's assisting our accounting department with fiscal year 21 financials. Greg and I are working through those now to reconcile them, and we should have a draft report, we hope, for the annual report next week, and have it be ready to submit to the Division of Retirement by the end of the month. And if you're available, the board had already said that once we get the report done, we'll email a draft to everyone, and then we can get the chairman's signature on the report and bring the full report back to the board in June for approval.
Perfect. I'll be around. All right, Joe, you have anything else for us?
No, I think that's it. I appreciate your time, and next time you'll see me, I'll have an actual evaluation report to review with you.
All right.
So I have just a real quick question for Joe. So Joe, you're doing an assumption studies. Are we going to see drips and drabs of this over what time frame, William?
Well, given everything that's been going on with the annual report and the financials, we suggested that Joe bring forward the assumption rate part of it now, because that's the most important assumption. I think, Joe, we had talked about postponing the rest of the experience study and expect to see that sometime in fiscal year 23. I'm not sure what your time frame was.
Yeah, I think from the standpoint of locking in the contributions for October 1, 2022 through the end of fiscal 2023, we'd like to finish this report, and then over the summer or even in the fall, bring the rest of the assumptions to the board for consideration. And then that would be applied to the October 1, 2022 valuation.
That's plenty of time.
So
from
another
a planning
quarter,
perspective.
another quarter or so.
Yeah, and that's time. That gives time for the sponsor to plan for.
Balance the checkbook. All right.
It doesn't matter anymore. Give me a break.
All right. All right. Well, thank you, Joe. We'll move on.
All right, thank you.
Thank you. The next item on the agenda, we've moved to June. And on informational items, we have Form 1 due in July 1, right?
Yeah, we just wanted to, we mentioned this before to the board and brought it before earlier a couple times this year, I believe, but we just wanted to remind everyone again, we don't want anyone to get, any of the board members to get stuck with fines.
$25 per day.
Yeah, well, I didn't get a response from her issue that she received that. Mine went in.
To the local supervisor of
Yeah,
elections.
it's Cassandra, I think, I believe it is, or something.
Is it Alachua County?
Huh?
Was it Alachua County or?
Supervisor of elections. But there's one girl that you send it to. And this year, so far, I haven't got a response that she received it.
Just for clarity, I think, I didn't realize, but Bob said if we had significant share plans, we should be listing that. Do you remember when he was discussing the Form 1?
Share, drop, ICMA.
457s also? Because when I read through it, I'm just copying what I put every other time, and that's, the numbers stuff hadn't changed. But
I don't know if you would care about putting the share plan on there. I would think your if you've got a 401 or a 457 or an IRA or an independent investment account like an E-Trade, that's what they're looking for. The share plan's not even really calculated, you know.
Technically, it's not,
yeah. Yeah, you don't put your defined benefit pension on there, right?
No.
So I would, yeah, that's part of the defined benefit pension.
You would if you were in the drop, though, according to Bob.
I think that's what he said. That's what I was trying to. Okay, so. Yeah, all right.
Yeah, not
well,
the value of the.
I own one residence. So.
I'm gonna put it on there just to be safe. I mean, until I care.
All right, so.
They got bigger fish to fry than me.
I think that's it for the Form 1. Is there public comment? Hearing none, seeing none. No further member comment. Next meeting date set for June 22nd, right here, 9 a.m. Is there a motion to adjourn?
Motion to adjourn.
Motion and seconded. All in favor?
Aye.
All right. Meeting is over.